Welcome to the Deep Dive. We unpack complex topics like earnings calls to get you the key insights fast.
Today we're digging into Lamb Weston's fourth quarter and their full fiscal year 2025 results.
Yeah, there's a lot going on there. New leadership, strategic shifts. Our goal is to figure out what it all means, especially their plan for the future.
Exactly. Can they really pivot under this new management? We'll look at the numbers, the strategy, the outlook, and what the analysts asked.
Okay, let's jump right in. Starting with the fourth quarter results, net sales were up.
Up 4% year over year, but the really eye-catching number was volume.
Right, up 8%. That's pretty strong.
It is, driven by new contracts across different channels and places. Plus, they were comparing against a period last year when they had that voluntary product withdrawal.
Ah, okay. So that helped the comparison. But what about pricing?
That's the interesting part. Price mix actually went down 4%.
Down, with volume up that much.
Yeah, it seems intentional. They mentioned supporting customers with pricing and trade promotions. It's competitive out there, and restaurant traffic isn't exactly booming globally.
Gotcha. So they sacrificed some price to keep or win that volume. How did that hit the bottom line? Adjusted EBITDA.
Pretty much flat. It increased just a tiny bit, like $2 million to $285 million. They did make good progress on improving working capital, though.
Okay, so Q4 was solid on volume, bit softer on price mix.
Yeah.
What about the full fiscal year 2025? How did that shape up?
Well, volume was positive for the whole year, and it definitely gained steam in the second half.
Good momentum then. But profitability?
That faced some headwinds. Those customer support actions we mentioned, higher costs because they had to curtail production at times, carrying higher inventories earlier in the year, and just general inflation pressure. It all added up.
But they managed some cost savings.
They did. Delivered $59 million, which was actually a bit better than they targeted. And operationally, cash flow looked good. $860 million from operations.
That's up from last year.
Yep. About $70 million higher year over year, mostly driven by those improvements in working capital. Shows some real discipline there.
And capital spending. I know they had big projects.
They spent $651 million on CapEx, but that's way down over $320 million less than the prior year. And it was below what they initially planned because those big expansion projects are mostly wrapping up now.
Okay, so pulling back a bit on the big spending, did they return cash to shareholders?
They did quite a bit, actually. Almost $500 million, $489 million total. That was split between $282 million in share buybacks and $27 million in dividends.
That definitely signals a focus on shareholder returns under the new team.
Speaking of which, fiscal 25 was a huge year for change, wasn't it? New CEO, Mike Smith.
And a whole bunch of new board members. 6, I think. Bradley Alford, Lawrence Cercius, Paul Mace, Timothy McLevish, Ruth Kimmelshoe, Scott Osfeld. That's practically a refresh.
It really feels like a reboot. The message from the call was clear. New leadership, new board, all aligned with a real sense of urgency.
Urgency to do what?
Drive results and rebuild investor credibility. That was the phrase they used. They're focusing on controlling what they can control, kicking off a new cost savings plan, and rolling out this focus to win strategy.
Focus to win. Okay. And they're tying compensation to it.
Directly. For fiscal 26, they've added free cash flow and returns on capital to the executive compensation metrics alongside the usual sales and adjusted EBITDA.
That's significant, putting their money where their mouth is.
And get this, the board unanimously decided to take their entire 2026 compensation in equity.
Wow. Okay, that sends a message. So this focus to win plan, how did they come up with it?
They did a full end-to-end review of the business, looked at everything, and that led to this plan. It includes things like zero-based budgeting.
Starting from scratch on budgets each year.
Exactly. Also looking at non-core assets, maybe divesting some things, and really sharpening their go-to-market approach.
Yeah.
It's a deep dive into efficiency and growth levers.
Makes sense. You need a clear strategy, especially with how the market's changing. French fry demand is still strong globally, right?
Oh yeah, demand is solid. But how people eat fries is evolving. More food delivery, QSRs expanding everywhere. Even things like air fryers at home are changing consumption patterns.
And where is the growth strongest geographically?
It's really popping in emerging markets. Now, those markets often have lower margins right now.
Right.
But they're also where the big QSR chains are expanding fastest. So it's a bet on future growth.
There was talk after COVID about too much new fry capacity coming online globally. Is that still a concern? Potential oversupply?
They address that. There have been announcements, yes, especially outside the U.S., but Lamb Weston believes the industry is staying rational. They estimate about 1 to 1.5 billion pounds of that announced capacity has already been canceled or delayed.
So not a race to the bottom, they think.
They seem confident, and they made a key point. Not all capacity is the same. Location matters. Technical capabilities matter. The reliability of your potato supply matter.
Quality too, I imagine.
Absolutely. A lot of the new capacity, say in India or the Middle East, might not be set up to make the higher margin premium products that Lamb Weston focuses on.
So their strategy is to win in those premium segments.
Precisely. They feel they have the right to win because they operate in very low-cost potato-growing regions, and they've invested in the specific capabilities needed for those higher-value products. It's about strategic fit, not just tonnage.
Okay, let's break down the focus to win strategy itself. You said 4 pillars. What's the first one?
First is focused investments, basically putting their money and effort into the global markets and segments where they have the best chance to lead and differentiate. Smart allocation.
Makes sense. Pillar 2. Strengthening customer partnerships. How are they doing that?
They believe their service and relationships are already top-notch with their biggest clients. The goal now is to roll that out consistently to all their priority customers and regions. More joint planning, being proactive, really understanding customer needs.
Okay, third pillar. Executional excellence. Sounds like Operations 101.
It is, but with a specific focus. Streamlining the supply chain, optimizing distribution, boosting plant productivity. They mentioned a zero-loss mindset for using raw potatoes and materials, cutting waste, maximizing efficiency everywhere.
From field to fryer, basically.
You got it. And the fourth pillar, setting the pace for innovation.
But this isn't just minor tweaks, right? They mentioned breakthroughs.
Exactly, like their fast fries concept, designed for places that normally couldn't serve good fries, easily think convenience stores, maybe even adapting for air fryers. It's about opening new channels and use cases. They're setting up global innovation hubs to drive this.
Interesting. Okay, shifting to the financials tied to this strategy. The cost savings program sounds ambitious. $250 million in annualized run rate savings by the end of fiscal 28. Can you quickly remind us what run rate means here?
Sure. Run rate savings means that's the full, ongoing yearly benefit they expect once all the actions are fully implemented. So while the total target is $250 million by FY28, they expect to have about $200 million of that run rate achieved by the end of FY27.
And how much hits in this coming fiscal year, FY26?
They're targeting about $100 million on a run rate basis in FY26, so a good chunk starting soon. About 2/3 of that should help gross profit. The other third helps SG&A.
But it costs money to save money, right? Any charges associated with this?
Yes, they expect $70 to $100 million in cash pre-tax charges, mostly landing in fiscal 2026 to achieve these savings. And that's on top of any leftover benefits from a smaller restructuring they did in FY25.
Got it. Now, crucial input, potatoes. What's the crop outlook?
Looking pretty good, actually. For North America, initial signs are positive. They expect mid-single-digit decreases in their contract prices.
Oh, that's a nice tailwind. When does that benefit hit the P&L?
Should start flowing through in the second quarter of fiscal 26. That's earlier than last year, more like the historical timing. Europe looks okay, too. Average crop costs maybe flat to slightly down.
Okay, so lower potato costs are a positive factor for FY26. Let's look at their official guidance. Anything unusual in the assumptions?
Well, they include a 53rd week in Q4, which helps a bit. They assume fry demand stays high, but they're not assuming restaurant traffic gets any better than it was in FY25.
So a conservative assumption on traffic.
Seems that way. But they do expect the customer momentum they built in the second half of FY25 to continue.
What's the revenue forecast then?
Between $6.35 billion and $6.55 billion. On a constant currency basis, that's anywhere from down 2% to up 2%. They expect the second half to be stronger, partly because of that 53rd week, and also because pricing actions will have less of a negative year-over-year impact compared to FY25.
And adjusted EBITDA guidance.
$1 billion to $1.2 billion. And a key change here. This number will now exclude non-cash share-based compensation expense.
Why make that change? How does excluding stock comp help investors?
Good question. It was about $40 million in FY25. By taking it out and restating past numbers, they argue it gives a clearer view of operational performance. Stock comp is non-cash, and it can fluctuate in ways management doesn't control day to day. So it's aligning with how many other companies report adjusted earnings, provides a cleaner operational trend.
Okay, makes sense. So within that EBITDA guidance, what are the moving parts? Gross profit?
Adjusted gross profit is expected to be down a bit. You've got the carryover impact of those pricing actions, ongoing customer support, some low single-digit cost inflation.
Offsetting the potato benefit somewhat.
Right. Partially offset by the lower potato costs. Plus, they have higher factory costs, especially internationally, with the new Argentina plant starting up in August.
And SG&A expenses. Selling, general, admin.
Expected to increase. Two main drivers, a $40 million headwind because incentive comp is normalizing back to target levels, and about $10 million in new investments for things like innovation and advertising, investing in growth.
What about CapEx for FY26? Still spending big.
Dropping significantly, they're guiding to about $500 million. $400 million of that is just maintenance and modernization, only $100 million for specific environmental projects. Definitely shows lower capital intensity ahead.
And working capital.
Yes.
Still a focus.
Absolutely. They expect to generate another $60 million in cash from improving inventory levels in FY26, and the same again in FY27. So $120 million total over 2 years. Clearly a priority.
Okay, let's talk about the Q&A with analysts. What were the key points? Did they get pushed on the lower margin outlook for FY26?
They did. Management acknowledged that the implied EBITDA margin, around 17%, is below their historical norm, but they stress it's temporary, driven by the pricing environment and those strategic investments. They kept emphasizing that fries are still super profitable for restaurants, high attachment rates, people order fries.
Did the strong Q4 volume help with anything else?
Yeah, it's significantly helped them bring down inventory levels. That ties back to the working capital improvement. Good sign of efficiency.
What about those GLP-1 weight loss drugs? Any impacts seen?
They said no material impact observed currently, but they're watching it closely, have the innovation team ready to adapt if needed. Aware, but not seeing a hit yet.
And the customer momentum they expect, is that just holding on to recent wins? Or are they expecting new business too?
It's both. Includes the carryover from wins in the second half of FY25, but also assumes they'll land some incremental new business in FY26.
And talk about tariffs. That's always a risk.
Yeah, they quantified it. If potential tariffs hit on August 1st, primarily affecting things like cooking oil and ingredients, they estimate about a $25 million hit to their financials. They're looking at ways to mitigate that, of course.
And strategy-wise, leverage targets. M&A.
Leverage target is still around 3.5 times debt to EBITDA, and they confirm they're open to M&A or joint ventures globally, but it has to fit the focus to win strategy, right markets, right capabilities, disciplined approach there too.
So wrapping all this up, what's the big picture for someone tracking Lamb Weston?
You're seeing a company actively turning a corner, or trying to, under very involved new leadership. There's a clear plan, the focus to win strategy, backed by aggressive cost cuts and very targeted investments.
Right. And that focus on cash flow, working capital, disciplined spending, those seem like key signals for investors wanting more operational predictability.
Definitely. And while the fry market is changing, they're clearly positioning themselves not just to compete today, but to capture growth in those premium segments and newer channels tomorrow.
All these moving parts definitely make you think about the investment case. Which brings us to our favorite part.
This is not financial advice segment. Remember, folks, this is purely for information and entertainment. Talk to a qualified pro before making any investment decisions. Okay, lay the outrageous but plausible idea on us.
All right, so the setup. Lamb Weston's guidance for fiscal 26 points to a tough first half. Pricing headwinds, higher SG&A kicking in. That EBITDA margin is going to look lower than usual temporarily.
Yeah. But the cavalry arrives in the second half.
Kind of. You've got multiple tailwinds converging later in the year. About half of that $100 million in FY26 cost savings run rate should hit the P&L in the second half. Lower potato costs start benefiting them from Q2 onwards. And the new Argentina plant ramps up production from August.
Okay, so a potential back half acceleration. What's the trade idea?
Consider looking at Lamb Weston, ticker LW, call options. Specifically, calls with an expiration date sometime after they report their second quarter fiscal 2026 earnings.
So betting on Q2 results and potentially revised upward guidance.
Exactly. The thinking is that the market might be underappreciating how much these different positive factors, cost savings, lower input costs, new capacity contribution, could boost results and the outlook as we get into the second half. If Q2 comes in strong and they sound more confident about the rest of the year, you could see a significant positive reaction in the stock. It's a bet on the timing of that inflection point.
Interesting. A precise play on fundamentals kicking in. So, to sum up our deep dive today, Lamb Weston has laid out a clear path with strategy changes, cost cuts, and a renewed focus on customers and innovation. They're positioning for the future evolution of the fry market.
Absolutely. Remember, everything we discussed today is to help you understand the company's direction based on their recent earnings call. Use it as a springboard for your own thinking and research. And maybe next time you order fries, think about the complex global machine behind getting that perfect fry to your plate.
That's all for this deep dive. Thanks for joining us.
Catch you on the next one.